Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today, we're diving into a filing from Sonendo, and let me tell you, it's a bit like a dentist promising a pain-free root canal. Sounds good, but is it too good to be true? We will check this out together. This report is called an 8K. It's basically a corporate uh-oh or ataboy moment, something significant enough that the company needs to tell the Securities and Exchange Commission, or SEC, and therefore all of us investors, about it right away. This one is dated February 28, 2025. The main event, Sonendo entered into an agreement, a fourth amendment to their existing credit agreement. Now, in simple words, they're changing the terms of their loan with Perceptive Credit Holdings. Think of it as renegotiating your mortgage to avoid foreclosure. This credit agreement involves Sonendo, some of its subsidiaries, the lenders, and Perceptive Credit Holdings. It is a legal document that outlines the terms and conditions of the loan. So what's changing? First, they're delaying a payment that was due in February to March. It is what is called kicking the can down the road, hoping things get better soon. More importantly, they're getting some temporary relief from having to make loan payments. The agreement waives or gets rid of some of the payments that were due or will be due soon. This means Sonendo gets a break from making those payments for a while. The agreement is also delaying future payments, pushing them further out into the future, specifically to March 2026. This gives Sonendo more time before they have to start making those payments again. There are strings attached. These delays and waivers depend on Sonendo securing some financing, raising capital by selling stocks. There are specific targets they need to hit in terms of how much money they bring in. There is a if you do this, we will do that. The lenders are telling Sonendo, we will give you a break, but only if you raise money. Of course, there is a disclaimer. They are saying this is not the whole story. Read the actual agreement for all the details. Because the agreement changes Sonendo's financial obligations, they need to disclose it. There are exhibits attached to the report. The most important one is the actual amendment document, so everyone can read exactly what was agreed upon. This is a technical file with data formatted in a specific way, XBRL, so computers can easily read and analyze the information. It's not something a regular person would look at directly. Now for the usual dose of caution, the company includes a warning about forward-looking statements, which are basically predictions about the future. They're saying, hey, don't take our word for it, things might change. All companies include this for legal reasons. These factors are described in detail in their official filings, including the annual report on Form 10-K and quarterly reports on Form 10-Q. These reports are available on the SEC's website. The report is signed by Bjarne Bergheim, President and CEO of Sonendo. Now, let's put this all together. Sonendo is a company that's feeling some financial pressure. They've renegotiated their debt to buy themselves some time, but they need to raise money and fast. I went to check the company's financials to get a broader picture. Keep in mind, I am looking at publicly available information. Looking at their most recent quarterly report for the period ending September 30, 2024, the company's cash position is a bit tight. They had around $16.8 million in cash and cash equivalents. However, their total liabilities are significantly higher, sitting at approximately $74.7 million. This difference raises concerns about their ability to meet short-term obligations and fund ongoing operations. The company reported a net loss of $15.7 million for the 3 months ended September 30, 2024. This loss is substantial and highlights the challenges Sonendo faces in achieving profitability. The big question is, can they pull it off? Here's my take. Sonendo is in a tough spot. Renegotiating debt is a good move in the short term, but it's not a long-term solution. They need to raise capital, which means convincing investors that they have a viable plan. One of their key strengths is their technology. They are in the business of root canal therapy, and their gentle wave system is designed to be more effective and less invasive than traditional methods. This could be a major selling point for investors, but they need to improve their financial performance. Reducing costs and increasing revenue will be critical. Their ability to successfully market and sell their products is also a major factor. There's a significant risk that they won't be able to raise the money they need. If that happens, they could face some tough choices, including restructuring or even bankruptcy. To conclude, Sonendo has potential, but they also face significant challenges. This is definitely a situation to watch closely. If you're an investor, it's important to do your homework and understand the risks before investing. Thanks for watching Corporate Decoder. If you found this helpful, please like, comment, and subscribe for more deep dives into the world of corporate filings.